हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 32 107 109 which talks about financial instrument which we had discussed in our previous class also. In previous class we had discussed some of the important definitions, like definitions, what is the financial instrument. Then we had discussed about what is financial asset. Then we had discussed the definition of financial liability. Then we had discussed the definition of equity with some examples. We had also discussed the difference between forward and future. We had discussed about the derivatives. What is derivatives? We had discussed the definition of derivative, definition of option. All these we had discussed in our previous class. Now we will discuss about the classification of the financial instrument. How these instrument is to be classified. This is very important for these standard. The classification covers more or less 70% part of the standard. So let's start. Now we will continue our topic with classification. What is classification? How it is done? Or the financial asset. In today's topic, we will discuss the classification of and measurements of financial asset. Then in upcoming videos, we will discuss about the classification and measurements of financial liability and also the equity, with some important illustrations and also the examples we will discuss in upcoming videos. In today's topic, we will discuss about the classification and measurements of financial asset. So what is a financial asset? It's a contractual right to receive cash. So financial assets are that assets is any asset that is cash and cash equivalent, investment in any other entities, instruments, equity instruments, a contract to receive cash or financial assets of another entity, exchange of financial assets and financial liability which is potentially favorable, and a contract that may be settled in entity's own equity instrument. This is the definition which we had discussed in our previous class, that is financial asset. Now we will discuss in detail the classification and measurements of financial asset, how we will recognize that financial asset in our books. So we will discuss the classification and measurements of financial asset. So what is how we will classify? There are three types of classification. Like firstly, we will check the amortized cost. Then we will go through fair value through OCI. Then there is a fair value through profit and loss account. Firstly, we will check the criteria or the condition of amortized cost. If these conditions are not satisfied, then we will check the condition of fair value through OCI. Then if these conditions, fair value through OCI, will not satisfy, then we will check fair value through profit and loss account. Fair value through profit and loss account is a residuary category. Generally, all the assets are recognized at an amortized cost. The condition of amortized cost, if not satisfied, then we look the other two categories, like fair value through OCI और fair value through profit and loss account. पर पहले हम लोग amortized cost ही का conditions ही check करेंगे for recognition of financial assets. If these conditions, if for are not satisfying, then we will check the other conditions like fair value through OCI or fair value through profit and loss account. तीन तरीके से हम लोग अपने फाइनेंशियल एसेट को मेजर कर सकते हैं. जैसे कि हम लोग मेजर कर सकते हैं थ्रू एमोटाइज कॉस्ट, थ्रू फेयर वैल्यू थ्रू OCI और फेयर वैल्यू थ्रू प्रॉफिट एंड लॉस अकाउंट. एमोटाइज कॉस्ट में मेजर करने और रिकॉग्नाइज करने के लिए दो टेस्ट सेटिस्फाई करना पड़ता है. वो है बिजनेस मॉडल टेस्ट टू कलेक्ट कॉन्ट्रेक्चुअल कैश फ्लो और SPPI टेस्ट. SPPI टेस्ट solely for the purpose of payment और प्रिंसिपल एंड इंटरेस्ट, उसको हम लोग कॉन्ट्रेक्चुअल कैश फ्लो टेस्ट भी बोलते हैं। जब ये दोनों कंडीशन सेटिस्फाई होता है तब हम लोग अपने फाइनेंशियल एसेट्स को रिकॉग्नाइज करते हैं एट एमोर्टाइज कॉस्ट in our reporting, like in our books we will recognize our asset, that is financial assets, if these two conditions of amortized cost are satisfied, then we will recognize at amortized cost. If these conditions are not satisfied, then we will check fair value through OCI. सो फेयर वैल्यू थ्रू ओसीआई में क्या बोला जाता है? फेयर वैल्यू थ्रू ओसीआई बोलता है बिजनेस मॉडल टेस्ट टू कलेक्ट एंड सेल। यहाँ पे अमोर्टाइज कॉस्ट में सिर्फ एसेट को आपको अमोर्टाइज कॉस्ट में आपको क्या चाहिए? अगर एसेट है आपके पास, फाइनेंशियल एसेट है, तो अगर आपको उससे रिटर्न में क्या चाहिए? अगर आपने कुछ इफ यू हैड गिवन एनी लोन to any other party, then what you will expect in return? You will expect the principal amount and also the interest भी वो market rate वाला interest, so interest आप एक्सपेक्ट क्या करोगे? प्रिंसिपल और इंटरेस्ट। तो अगर आपका ये एसपीपीआई टेस्ट होता है कि अगर आपको आपका एक्सपेक्टेशन है कि आप कुछ अगर इन्वेस्ट कर रहे हो तो उससे आपको क्या रिटर्न मिले। अगर आपको सिर्फ एक्सपेक्टेशन है इंटरेस्ट और प्रिंसिपल का, तो वो उस एसेट को आप एमोर्टाइज कॉस्ट में रिकॉग्नाइज करोगे। और आप बिजनेस मॉडल टेस्ट भी आपको सेटिस्फाई करना पड़ेगा कि एट द डे वन आपका इंटेंशन क्या है, कि आप उस एसेट को टिल मेच्योरिटी रखना चाहते हो कि आप उसको बिफोर मेच्योरिटी सेल कर देना चाहते हो। अगर आप रखना चाहते हो टिल मेच्योरिटी, योर इंटेंशन इज टू कीप दैट एसेट टिल मेच्योरिटी और उससे आप प्रिंसिपल इंटरेस्ट रिकवर करें, तो उस एसेट को आप एमोर्टाइज कॉस्ट में रिकॉग्नाइज कीजिएगा। ये दोनों कंडीशन सेटिस्फाई करना पड़ेगा, तभी आप एमोर्टाइज कॉस्ट में रिकॉग्नाइज कर सकते हो। अगर एनी ऑफ द कंडीशन अगर फुलफिल नहीं होता, फेयर वैल्यू थ्रू ओसीआई क्या बोलता है? फेयर वैल्यू थ्रू ओसीआई बोलता है कि इसमें भी दोनों कंडीशन आपको सेटिस्फाई करना पड़ता है। फेयर वैल्यू थ्रू ओसीआई, अगर एनी ऑफ द कंडीशन अगर सेटिस्फाई नहीं होता है तो आपको फिर फेयर वैल्यू थ्रू प्रॉफिट एंड लॉस चेक करना पड़ेगा। तो आप पहले फेयर वैल्यू थ्रू ओसीआई का क्या कंडीशन है वो हम लोग डिस्कस करते हैं। बिजनेस मॉडल टेस्ट टू कलेक्ट एंड सेल, यहाँ पे कलेक्ट करना ही नहीं, यहाँ पे ये कंडीशन है कि अगर आप फेयर वैल्यू थ्रू ओसीआई में अगर आप अपने वैल्यू एसेट को रिकॉग्नाइज कर रहे हैं, तो वहां पे पहला कंडीशन ये होना चाहिए कि आपका इंटेंशन होना चाहिए कि टू कलेक्ट। अगर आपका इंटेंशन कलेक्ट एंड सेल करने का है, तब उस एसेट को आप बिजनेस फेयर वैल्यू थ्रू ओसीआई में रिकॉग्नाइज कीजिए। लेकिन अगर आपका इंटेंशन कलेक्ट करके उसको हेल्ड टिल मेच्योरिटी रखने का है, तब आप उसको एमोर्टाइज कॉस्ट में रिकॉग्नाइज कीजिए। यहाँ पे मैनेजमेंट का अगर इंटेंशन है उस फाइनेंशियल एसेट को वो कलेक्ट करे, लाइक वो बॉन्ड्स अगर मैनेजमेंट ने परचेज किया, सपोज एनी एंटिटी हैज परचेज अ बॉन्ड और उसका इंटेंशन है वो 10 साल का बॉन्ड है, उस पर इंटरेस्ट 10% है, और मैनेजमेंट का इंटेंशन है, एंटिटी का इंटेंशन है कि वो 6 साल बाद उस बॉन्ड को सेल कर देगा, वो मेच्योरिटी तक नहीं रखेगा, और उससे जो रिकवर होगा उसका प्रिंसिपल और इंटरेस्ट वो अदर बेटर अपॉर्चुनिटी में वो इन्वेस्ट करना चाहता है, तब वो फेयर वैल्यू थ्रू ओसीआई में रिकॉग्नाइज करेगा अपने फाइनेंशियल एसेट को। क्योंकि इंटेंशन इज टू बी डिसाइडेड ऑन द डे वन एट द टाइम ऑफ रिकॉग्नाइजेशन, एट द टाइम ऑफ चेकिंग द क्लासिफिकेशन मेजरमेंट। जिस टाइम आप अपने एसेट को क्लासिफाई कर रहे हो मेजरमेंट के लिए, रिकॉग्नाइज करने के लिए, एट डे वन यू हैव टू डिसाइड वेदर यू हैव टू रिकॉग्नाइज दैट एट अमोर्टाइज कॉस्ट या फेयर वैल्यू, या फेयर वैल्यू थ्रू ओसीआई, या फेयर वैल्यू थ्रू पीएल। यू डोंट मीन चेंज योर मीन्स मेजरमेंट प्रिंसिपल्स। आप अपने रिकॉग्नाइजेशन क्राइटेरिया को रेगुलरली चेंज नहीं कर सकते। वंस यू हैव डिसाइडेड टू रिकॉग्नाइज दैट एसेट थ्रू फेयर वैल्यू थ्रू ओसीआई, तो आपको उसी में रिकॉग्नाइज करना पड़ेगा। एसपीपीआई टेस्ट भी आपको चेक करना पड़ेगा सोली फॉर द पर्पस ऑफ पेमेंट एंड इंटरेस्ट, दैट इज कॉन्ट्रेक्चुअल कैश फ्लो टेस्ट। तो यहाँ फेयर वैल्यू थ्रू ओसीआई में रिकॉग्नाइज करने के लिए आपको दो टेस्ट चेक करने हैं, दोनों ही टेस्ट सेटिस्फाई होना पड़ेगा, तभी आप उसको रिकॉग्नाइज कर सकते हो थ्रू फेयर वैल्यू थ्रू ओसीआई। पहला टेस्ट है बिजनेस मॉडल टेस्ट टू कलेक्ट एंड सेल। इंटेंशन ऑफ द एंटिटी इज टू कलेक्ट दैट मीन्स टू invest on that asset and not held till maturity. Before maturity the entity has sold that asset, so intention of the management to sell that asset before maturity. And the SPPI test, intention of the management to collect the principal and also the interest. So it's a contractual cash flow test. Both the SPPI test is common in amortized cost also and fair value through OCI. Because SPPI test, four conditions are there, interest is there, management want interest, then also the principal amount, then also any rate of interest like 0% rate of interest is also an interest rate. If you are investing any asset at a 0% rate of interest also, that also satisfy the SPPI condition. And also the assets are not linked, the assets are not linked with market, means they are not linked with indexes like consumer price index, commodity index, any share price index. The asset is not linked with that. The asset is only linked, the fair value measurement of that asset is only linked with the inflation, not with any other indexes, only with the inflation index they are linked, then it satisfies the SPPI condition. And so any of the condition if not satisfied, then you have to check the other criteria like fair value through profit and loss account. Fair value through profit and loss account is a residuary category, means if amortized cost and fair value through OCI fails, then we will look into the fair value through profit and loss category. So it's a residual category. But if an asset held for trading, keeping an asset for a trading purpose, and it's a derivative instrument, then it will be recognized through. These are the types of classification of the financial assets. Now we will discuss each and every item in detail. So firstly we will discuss the amortized cost. What is an amortized cost? Amortized cost is the amount at which financial asset or financial liability are recognized. Amortized cost is that amount at which the financial asset or financial liabilities are recognized in the books. How amortized cost is to be recognized? Opening balance plus transaction during the year, less collection, add interest, less bad debt or provisions if any, then it will be the amount comes out, that is the amortized cost. And now we will discuss the examples, some of the important examples like financial instrument or financial asset recognized at amortized cost. Some of the examples like which asset we will recognize at amortized cost. There are some examples like we will recognize like debtor. Debtor is a financial instrument. As we know that debtor is a financial instrument because there are two parties exist. There is a contractual, there is a binding contract between the two parties, and because there is a monetary value also exists. So it's a financial instrument, satisfies the definition of financial instrument. Then it satisfies the definition of financial asset, a contract between the party and a contract to receive cash from other entity. So it's a financial asset. So it satisfies the definition of financial asset. In also it satisfies the amortized cost, because it is, if it satisfied the definition of financial instrument, it satisfies the definition of financial asset, then it is we will check the whether it is recognized at amortized cost or not. Because in debtors there is a two tests we will check: business model test to hold the asset till maturity, or there is a contractual cash flow to receive principal and interest. In debtors case, we will receive the SPPI test is satisfying the SPPI test, because there is a credit period of 45 days, and before the entity should receive any asset, any cash after the credit period. So hold till maturity, business model test to hold the asset till maturity is satisfying. And also there is a contractual cash flow, because the entity has to receive the principal amount and also the interest. Intention of the management to receive a contractual cash from the another entity. So it's satisfying the definition, so it will be recognized at amortized cost. Trade receivables, loan given. Loan given, in that case you will, your management entity is to receive the principal and interest, and also held asset till maturity, till the period the loan is given, then it will be recognized at amortized cost. Cash. Cash is also security deposits in lending arrangements. Like if you give any security deposits, what you will expect? You will expect that security deposit after the period, after the tenure of the period is over. Like if you had given security deposits for 5 years, after that 5 years you will receive the principal along with some interest. So you will, it's a financial instrument, it's a financial asset, because there is a right to receive cash. So and you will recognize, you will satisfying the condition of amortized cost, because the intention is to receive the principal and interest, that is SPPI conditions are fulfilling. Business model test to held asset till maturity is fulfilling, so it will be recognized at amortized cost. Investment in debentures, investment in bonds, provided not held for trading. Investment in shares like equity preference cannot be recognized at amortized cost, because they are linked with market. They are not linked with inflation. They are linked with the market. So they are satisfying, even they are satisfying the three conditions of SPPI, but fourth condition of SPI, that is consumer, they are linked with the market share price. Investment in shares like Reliance, Bharat Airtel, and investment in Tata Motors, Tata Steel, all these are linked with the market. So they are not recognized at amortized cost. They are recognized always at, whether at fair value through OCI, through fair value through profit and loss account, not recognized at amortized cost. So investment in shares like equity investments or preference cannot be recognized at amortized cost, because they are, even they are the financial asset, but they are not satisfying the condition of amortized cost. Now we will discuss what is the effective interest rate. It is the rate at which discounts the future cash inflows or outflows over the contractual period in order to compute the gross carrying amount of financial assets or financial liability. So effective interest rate is that rate which discount the future cash inflows or outflows over the contractual period. That is, it's a discounting rate to find out the carrying amount of financial assets and financial liability, and it is discounted over the contractual period in order to compute the carrying value. So EIR is the IRR, that is internal rate of return, that is rate at which NPV equals to 0, or IRR is the rate where present value of cash inflows is equals to present value of cash outflow, where NPV becomes 0 and where cash inflow equals to cash outflow, that is the effective interest rate, in order to find out the carrying value of the financial asset or financial liability. Now, conditions of amortized cost. Both conditions needs to be satisfied in order to recognize any financial asset at an amortized cost. First condition is business model test to collect contractual cash flow. Business model test to collect contractual cash flow, and SPPI test, that is solely for the payment of principal and interest, or we can say that contractual cash flow. So there are two test conditions of amortized cost, that is both the conditions need to be satisfied, that is business model test to collect contractual cash flows and SPPI test, that is solely for the payment of principal and interest, or contractual cash flow test. So these conditions, if an entity is satisfying, then they will recognize the asset at an amortized cost. What is an amortized cost? That is at what amount they will recognize. They will recognize the, that is initial recognition, then any transaction during the year, then that reduce with the collection any amount, then increase with interest. Interest is to be calculated at effective IRR, that is effective interest rate, and any bad debt or provision that brings comes out with amortized cost. So that is the amortized cost, and if these tests are satisfying, then only the financial asset is to be recognized at a business at an amortized cost. So what was the condition? What are the features of business model test to collect contractual cash flow? That is, firstly, the entity will check the first condition, that is business model test to collect contractual cash flow. Intention is to collect interest and principal on maturity. Means intention of the management is to collect the interest and principal on maturity. Means the objective of the company is to collect the cash flows arising from the contract. Any contract if an entity do, the intention of the company, the objective of the company to hold that asset till maturity in order to collect the interest and principal on that asset. Means to hold the asset till maturity. If due to any unforeseen circumstances or scenario, subsequently, not at the time of recognition, at the time of initial recognition, subsequently means after recognition, if any due to unforeseen situation or scenario arises, and the financial asset is actually being sold by the company before maturity period, even then all at that time also the business model test will get satisfied. We will check the intention of the management to recognize that asset at amortized cost, and these model test is to be satisfied at the time of initial recognition. If any change arises subsequently, means after initial recognition, thus that doesn't matter. But at the time of initial recognition, the intention is to be seen. So business model test is to be checked on the day one at the time of initial recognition when the company enter into the transaction, not subsequently. They will not check that test subsequently. If any unforeseeable situation arises, for that case, for due to that situation, the entity has to sold that asset. It does not affect any transaction. It does not affect the business model test. So intention of the management is to be checked at the time of the initial recognition when an entity enter into the transaction. They has to check on that date only. The intention is to be seen to collect the principal and interest and held the asset till maturity at the time when the entity enter into the transaction, not subsequently. This is to be explained with the help of example like business model test. There is an example of business model test, that is, suppose R Limited has invested in fixed deposit of rupees 1 crore at an interest rate of 10% for 10 years. What was the intention of R Limited? Is to keep that asset till maturity, till 10 years, not to sold that asset before maturity. So intention of the R Limited is to receive the principal as well as the interest after maturity, hold the asset till maturity. So it satisfies the condition of business model test, because both the condition of business model test is satisfying. So one condition of amortized cost is satisfied. But if, and another condition is SPPI test, that is, in that case there is also an interest, there is also a principal. Interest may be at any rate like 10%, 15%, 0% rate is also a rate of interest. If you are investing at a 0% rate of interest, it is also treated, it is also fulfilling the SPPI test, and it should not be. Means with any index like consumer price index, share price index, the asset is not linked with. It is only linked with the inflation price index. Inflation index, it is also only linked with inflation index, not with any other indexes. Then both the conditions of amortized cost is to be fulfilled, then the asset is to be recognized at a amortized cost. Then the second condition, that is second features of amortized cost, that is SPPI. SPPI is the solely for the principal and interest, solely for the purpose of payment of principal and interest, or it can, you can say it a contractual cash flow test, that is CCFC test. In these tests, there is a principal and interest should exist in the transaction. There is the interest and principal, both these are exist in the transaction. Interest can be any percentage like 10%, 15%, 100%, even 0% is to be treated as an interest only. Interest can be fixed or floating. It may be fixed, like fixed rate of interest, you can say 10%, 12%, 15% fixed rate, and floating rate is depend on the LIBOR, MIBOR. LIBOR plus 0.5%, MIBOR plus 0.2%. That is the floating rate. We depend on the LIBOR or MIBOR. So, principal and interest should exist in the transaction. Interest can be any percentage, like 0% rate is also a rate of interest. Interest can be fixed or floating. Principal and interest shall not be linked with any equity price of the company or any index. It should not be linked with equity price of the any entities or any indexes like share price index, consumer price index, oil price index, commodity index, etc. Except inflation index. If it is linked with the inflation index, then it's satisfying the SPPI test. If it is linked with equity price index, share price index, consumer price index, oil price index, it does not satisfy the SPPI test. SPPI test is failed if it is linked with the share price index. So these are the conditions of SPPI. If these conditions are satisfying, then the asset is to be recognized at amortized cost. So business model and SPPI is fulfilling. If both the conditions are fulfilled together, then it will be recognized at an amortized. Is to what was the basic lending arrangement? They had to check the inflation. They had to check the credit risk, reasonable profit margin. If bank has given you a loan, suppose bank has given you a loan, then what bank will check, at what rate of interest they will give. They will check the inflation, market inflation. Then they will check how much credit risk is on you to repay the loan. They will check that if the credit risk is low, then low rate of interest is to be given. If the credit risk is high, then high rate of interest is to be given. And also a reasonable profit margin to give the loan. So that is the basic lending arrangement. Without these criteria, they will not lend. Now, in order to clarify more, we will of SPPI test, we will take the example. So this will more clarify. So this is to be explained with the help of example in order to check the SPPI test. Suppose R Limited has invested in fixed deposit of rupees 1 crore at interest rate of 10% for 10 years. So whether it's a financial instrument, yeah, it's a financial instrument because there is a contract between two parties and also denominated in monetary value. There is a monetary value is there. There is a contract is there between the two parties, and the contract is denominated in monetary value because 1 crore is to be invested in order to receive interest and principal. It's a financial asset. Whether it's a financial asset, yes, it's a financial asset because there is a contractual right to receive cash. Classification, at what classify this asset is to be recognized at amortized cost or fair value through OCI or fair value through PL, we have to check the classification. Firstly, we will check the conditions of amortized cost, whether it's satisfying the business model test to collect, because the intention of the R limited is to hold the asset till maturity in order to collect the interest and principal. So it's satisfying the business model test to collect, that is held till maturity. In this example, intention of R limited is to hold the asset till maturity in order to collect the principal and interest. So it's satisfying the business model test, SPPI test, because in this transaction, interest is present, principal is present, interest is at fixed rate of interest, and it should not be linked with any indexes like any share equity share prices. So it is satisfying the condition of SPPI test. And if both the conditions are satisfying, the asset is to be recognized at amortized cost. So in this case, fixed deposit is to be recognized at an amortized cost. In this way, we will explaining the example of SPPI. Now we will take some important examples in order to clarify our discussion on amortized cost, on business model test, to held the asset, on SPPI test. So illustration number 1, an entity hold investment to collect their contractual cash flow. The funding need of the entity are predictable and the maturity of its financial asset is matched to the entity's estimated funding needs. The entities perform credit risk management activates with the objective of minimizing credit losses. In the past, sales have typically occurred with the financial assets. Credit risk and increase such that the asset no longer meets the credit criteria specified in the entity's documented investment policies. In addition, infrequent sales have occurred as a result of unanticipated funding needs. Report to the key management personnel focus on the credit quality of the financial assets and contractual returns. The entity also monitor fair value of the financial assets among other information. So in the first line also, only said that evaluate the business model. Which model is it? So in the first line, itself says that an entity's intention is to hold the investment till maturity because to collect their contractual cash flows. The entity's intention is predictable and maturity of its financial asset when the entity mature that match with the entity's funding need. If any need of the entity is there, it should be funded from that financial asset. In that way, they will invest their financial asset. Entity invest their financial asset in such a way whenever the entity require its funding, it will be recovered from the maturity of that financial asset. Suppose the entity needs after 6 months any want to do any project. For that, what an entity do? Intention of the entity to park some of the amount for 6 months in such a way that at the time of maturity the entity will fulfill its need. The objective of entity perform its credit risk management activities with an objective, with some objective like minimizing its credit losses. Infrequent sales have occurred as a result of anticipated funding needs. Because they do not sell frequently, the infrequent sales have occurred, and the any mismatch, any quality credit quality is to be reported to the management, key management personnel, and they will check the credit quality of the financial asset and the contractual returns. An entity also monitor the fair value of the financial assets. So these models are satisfying the condition of business model test to hold the asset till maturity, and also these investment meets the business model test to collect contractual cash flow. Actual sales of financial assets subsequently will not impact because infrequent sales are there, which is subsequently, not at the time of making the transaction. So it will not impact the business model test. Evaluation of business model test is to be done at the time of entering into the transaction. All the tests required for SPPI and business model test to hold the asset till maturity are fulfilled. Hence, the business model test to collect contractual cash flow by holding the asset till maturity, and it should be recognized at amortized cost. So, it's a business model test because both the model test of hold the asset till maturity, because here the intention of the management, the funding need of the management is on the maturity. They invest in such a way that their needs are to be satisfied at the time of maturing that asset. So intention is to be clear that they will keep the asset till maturity. Infrequent sales are there. So it will for satisfying the business model to collect the contractual cash flow. Now illustration number 2. An entity business model is to purchase portfolios of the financial asset such as loans. Those portfolios may or may not include financial assets that are credit impaired. So, an entity's business model is to purchase a portfolio of financial assets such as loans. Those portfolios may or may not include financial assets that are credit impaired. If the payment on the loan is not made on the timely basis, the entity attempts to realize contractual cash flows through various means of, for example, by contacting the debtors by mails, telephones, or other methods. The entity's objective is to collect the contractual cash flows. An entity does not manage any of the loans in the portfolio with an objective of realizing cash flows by selling them. In some cases, the entity enter into interest rate swaps to change the interest rate on a particular financial asset in portfolios from a floating interest rate to fixed interest rate. Evaluate the business model. The objective of the entity's business model is to hold the financial asset in order to collect the contractual cash flow. The same analysis would apply even if the entity does not expect to receive any of all of the contractual cash flows. This the same analysis would apply even if the entity does not expect to receive all of the contractual cash flows. For example, some of the financial assets are credit impaired at the time of initial recognition. So the objective of these is to hold the asset and to collect the contractual cash flow even if in case of credit impaired asset also these method is to be applied. Moreover, the fact that the entities enter into derivatives to modify the cash flows of the portfolio does not itself change the entity's business model. Means if there is a swap in rate that is from fixed to floating, it will not impact the business model test. Now, illustration number 3. Entity B sells goods to customer on credit. Entity B typically offers customer up to 60 days following the deliveries of the goods to make the payment in full. Entity B collect cash in accordance with the contractual cash flows of the trade receivables and has no intention to dispose of the receivables. It is a clear cut trade receivables, it's a clear cut debtors. So entity's objective is to collect the contractual cash flows from trade receivables, and therefore trade receivable meets the business model test for the purpose of classifying the financial asset at amortized cost. The intention of the entity is not to dispose of the trade receivable. The intention of the entity is not to sell the asset. not to sell the dispose of the trade receivables. The entity intention is to collect the contractual cash flows after 60 days, and it is to be classified as amortized cost. Now next one is illustration number 4. An entity purchase a debt instrument for rupees 1 lakh. The instrument pay interest of 7,000 annually and has 10 years to maturity when purchased. The entity intends to hold the asset to collect the contractual cash flow. The intention of the entity is clear. He wants to hold the asset till maturity, and also intention is to collect the principal and interest. Interest may be any percentage, like 0% rate is also an interest rate. So it should be recognized at amortized cost. Classification is to be done at amortized cost. It's a financial instrument, it's a financial asset, and objective of the entity is to hold the asset till maturity in order to collect the principal and interest. So the debt instrument would meet the hold to collect business model test, and it should be recognized at an amortized. Now, illustration number 5. An entity purchases a debt instrument of 1 lakh. The instrument pay interest of 7,000 annually and has 10 years to maturity after when purchased. The entity intention is to hold the asset to collect the contractual cash flow. After 6 years have passed, the entity is suffering a liquidity crisis and need to sell the asset to raise the fund. Evaluate the business model test. In this case, the intention of the entity is to be checked at the time of getting into the transaction. Means on the day one when the company enter into the transaction, at that time the intention is to be seen. At that time, the intention of the entity is to keep the asset, but due to some liquidity crisis arises after 6 years, they, because due to unforeseen situation, they had to sell the asset. It will not impact these unforeseen situation. For that reason, the entity has to sell the asset before maturity, will not impact the business model test. At that time also, it will be recognized, it will satisfy the business model test to collect the contractual cash flow. Since the sale of the financial asset was not expected on initial recognition, classification and therefore does not affect the classification. There is no retrospective reclassification. Thus, the debt instrument would still meet the hold to collect business model test. Now, illustration number 6. A financial institution hold financial assets to meet liquidity needs in a stress case scenario. Means a financial institution hold financial asset to meet liquidity needs in a stress case scenario. For example, a run on a bank deposits. The entity does not anticipate selling these assets except in such scenarios. The entity monitors the credit quality of the financial asset, and its objective in managing the financial asset is to collect the contractual cash flow. The entity evaluates the performance of the asset and, on the basis of interest revenue entered and credit losses realized. However, the entity also monitors the fair value of the financial asset from a liquidity perspective to ensure that the cash amount that would be realized if the entity needs to sell the asset in a stress case scenario would not be sufficient to meet the entity's liquidity debt. Periodically, the entity makes sales that are insignificant in the value to demonstrate liquidity. Evaluate the business model test. In meeting the definition of hold to collect till maturity, and hence these are measured at amortized cost, because financial institution holds the asset to meet liquidity need in the stress case scenario. The intention of the management to hold the asset to meet the need of the in stress case. The intention of the entity is not to sell these assets except in such scenario. Means they want the financial asset And in stress case, they have to sell. Except that they don't want to sell the asset. They want to keep the asset till maturity. The entity monitor the credit quality of the financial asset, and its objective in managing the financial asset is to collect contractual cash flows. So it's satisfying the business model test because to collect contractual cash flow, because intention is not to sell the asset except in unforeseen situation, except in stress case. So entity evaluates the performance of the asset on the basis of interest revenue and credit loss realized. The entity also monitor the fair value of the financial asset from a liquidity perspective to ensure that the cash amount that would be realized if the entity needs to sell the asset in a stress case. So scenario would be sufficient to meet the entity's liquidity needs. So this model is the business model test to hold the and hold to collect. It is meeting the definition of business model to test to collect the contractual cash flow, means hold to collect till maturity, and hence business model test to hold and collect the contractual cash flow is. Now fair value through OCI. We had discussed the fair value through amortized cost. Now we will discuss the conditions that fair value through OCI. Firstly, we will discuss what is an OCI. OCI is the other comprehensive income. OCI means notional gain or loss which are not in the routine nature of the business to be recognized. Means the OCI is the notional gain and loss which recognized, which is measured at fair value. Means any gain and losses arises due to fair value difference in the fair value of the financial asset, then it is not an actual gain and loss, it's a notional gain and loss, and any notional gain and loss is to be recognized in OCI which is not in the routine nature of the business. So there are two categories of OCI items to be recognized. What item is to be recognized? There are two items which is to be recognized in OCI. That is item to be reclassified to profit and loss account subsequently, and item not to be reclassified. Firstly, item to be reclassified to profit and loss account. Subsequently, like net investment hedge, cash flow hedge, fair value gain or loss on debt instruments, foreign currency translation reserve accounts, and shares of profit and loss in associates, joint ventures. These are the items to be classified to profit and loss account subsequently. Net investment hedge arises due to Ind AS 109. Cash flow hedge arises due to differences in fair value as per Ind AS 109. Fair value gain and loss on debt instrument arises as per Ind AS 109. Foreign currency translation reserve, if any difference arises, which should be if any notional gain arises or loss arises, is to be discussed in Ind AS 21 in detail. Foreign currency translation reserve and shares of profit or loss in associates and joint ventures to be discussed in detail in Ind AS 27 and 28. Item not to be reclassified to profit and loss account, that is actuarial gain and loss on defined benefit obligation. It should be discussed in Ind AS 19. Revaluation of property, plant and equipment and tangibles in details in Ind AS 16 and 38. Fair value gain and loss in equity instrument Ind AS 109. Capital reserve and share of profit and loss in associate joint venture in Ind AS 27 and 28. So item to be classified, reclassified, and item not to be reclassified to profit and loss account. There are two categories items to be recognized in the OCI. But today's topic we will discuss only the third point of items to be reclassified to profit and loss account, item not to be reclassified. That is fair value gain and loss on debt instruments and fair value gain and loss on equity instrument. We will discuss today only this. That is item to be reclassified and item not to be reclassified. Item to be reclassified to be to profit and loss account, that is the debt instrument. If any fair value gain or loss arises on debt instrument, then that instrument is to be reclassified to profit and loss account. And item that is fair value gain and loss on equity instrument, that item not to be reclassified to profit and loss. Today we will discuss that only. That is what is the debt instrument, what are the equity instrument, and how fair value gain or loss arises, and how notional gain and loss which will impact, which will transfer, which will recognize through fair value through OCI. Now, change in the fair value of debt instruments and equity instruments to be recognized in OCI. If there is a change in the fair value of debt instrument, what are the debt instruments? Firstly, we will check what are the examples of debt instruments and what are the examples of equity instruments. Like debt instrument, investment in those assets whose nature are in debt type of nature, like to receive the principal and interest, like for investment in debentures, investment in bonds, investment in nature of the preference shares, that is of liability nature, not of equity nature. If you are investing with an intention to hold the asset till maturity, with an intention to receive contractual cash flows, with an intention to receive interest and principal, then that asset is to be treated as a debt instrument. But if it is linked with the equity price index, then that asset is to be treated as an equity instrument, like investment in equity shares, investment in preference shares of equity nature. Then that is to be that assets are equity nature, and any change in the fair value of that asset is to be recognized through OCI. And we will discuss firstly the characteristics of the test, the characteristics and conditions of fair value through OCI. Firstly, we will discuss, then we will discuss the accounting treatment. So conditions of fair value through OCI, both the condition needs to be satisfied, that business model test to collect and sell. Here the intention is to collect and also the sell the asset, and also fulfill the SPPI test solely for the purpose of payment of principal and interest or contractual cash flow. Even if the interest rate is zero, it will satisfy the SPPI test. So, an SPPI test in this case also are similar to the amortized case. Amortized cost case, whatever we had discussed, the conditions are same in SPPI. Like in this case also, the SPPI is similar to that of the amortized cost. So if both the conditions are satisfying, then that asset is to be recognized at fair value through OCI. Now, first condition is first condition is business model test to collect and sell. We will check the features of that asset. Features of business model test in case of fair value through OCI is the objective of the entity is to collect the contractual cash flow and to help to sold the asset before the maturity. If the intention of the management is to collect the contractual cash flow from that asset and to sell the asset before maturity, then that asset is to be recognized at fair value through OCI. And features of SPPI is similar to that of the as discussed in amortized cost, like there's a in these transactions there's a principal and interest. The principal and interest is there. Interest may be at any rate, like 0% is also a rate of interest. If you are investing at 0% rate of interest, that is also an interest rate. The interest may be fixed or floating, and it should not be linked with the market price. So but in this case solely it should not be linked with the market price, only it should be linked with the inflation. So these are the features of SPPI. And the next features of SPPI business OCI is business model test to collect the contractual cash flow and to sell the asset before maturity. But in this case, there is an exception In case of SPPI, that like it should not be linked with the market price. If any asset is linked with the market price, like a investment in equity instrument, then that asset, there is a exemption to that asset, and they will recognize that fair value through OCI. So we will discuss that, like irrevocable exemption of fair value through OCI. In these exemption, once the option is taken, the company cannot change the option subsequently. These exemption is only for the investment in equity instrument, like equity shares, preference shares in the nature of equity, where the investment in equity instruments is held for trading. Such investment is recognized at, means there is some irrevocable exemption is given to the fair value through OCI. In this case, if that asset is linked with market also, that asset is to be recognized at fair value through OCI. There is some assets like investment in equity instruments like equity shares, preference shares. If it is the nature of equity, except if it is held for trading. If the asset is held for investment purpose, it should be recognized through fair value through OCI. But if it is the asset is held for trading, that asset is not recognized in fair value through OCI. It should be recognized at fair value through profit and loss account. Irrevocable exemption is what? When an investment in an equity instrument is not held for trading, and the company has an irrevocable option to classify investment in equity shares instruments either at, means in that case, if the asset is, if the investment entity has not held that asset for trading purpose, and there is an option, irrevocable option, that if the entity has invested in any equity instrument, they will either recognize at fair value through OCI or fair value through PE. They can recognize in both, but once they had applied any of the condition, they will not go for another condition. Such exemption is available at different instrument levels, means in the below financial asset, if the company opt for fair value through OCI, then the company has to follow these in the future also, and the company cannot route it to fair value through profit and loss account, and vice versa. Means if the investment, if the company has invested in equity shares of subsidiary 1, and if he applied fair value through OCI, if he had measured his asset through fair value through rooted in asset through fair value through OCI, then he will not choose to uh, in the future year that he will route through fair value through profit and loss account. Once he had applied fair, in case of investment in equity shares of S2, like if the entity opt to follow the fair value through profit and loss account, then he will not opt for fair value through OCI. Investment in associates, if we opt for fair value through OCI, he will not opt for fair value through profit and loss account. In the vice versa, if any of the entity, if the entity opt for any of the classification, he will not opt for. Suppose A Limited had invested in debentures of B Limited of rupees 1 lakh at an interest rate of 10% for 10 years. The date of investment is 1st January 2023. The fair value on the date of reporting, that is 31st March 2023, is 1,50,000. The intention of the A Limited is to collect contractual cash flow and not to hold the asset till maturity. On 31st March 2024, A Limited sold the debenture at fair value of rupees 2 lakhs. So in these case, business model of A Limited is to collect principal and interest, to sell financial asset after 1 year, and invest in different business opportunity. Solution is that the objective of A Limited is not to hold the financial asset but to sell before maturity. Business model test to collect and hold till maturity will get failed, means the intention of the A Limited is not to hold the asset, so it not satisfying the condition of amortized cost, because the intention is not fulfilling. Business model test to hold the asset till maturity will get failed. business model test to hold and to collect and sold before maturity get satisfied. So it should be recognized at fair value through OCI. Thus, the investment in debenture cannot classified as amortized cost. Such investment in debenture shall be classified as fair value through OCI, provided SPPI condition will met. Now, accounting entry on the date of purchase on 1st January 2023, they will make an accounting entry, that is investment in debentures account debit to bank, that is 1 lakh. Now, on the reporting date, there is a change in fair value from 1 lakh to 1,50,000. That is on 31st March 2023. They make an entry, fair value, that is investment in debenture increment is 50,000, and it should be recognized as fair value gain OCI through 50,000. And they will disclose in the OCI relevant extract, that is on 31st March 2023, items to be reclassified. In that, they will recognize fair value gain on investment in debentures 50,000. An item not to is nothing is there, so it not be. And balance sheet extract me 31st March 2023 investment in debenture, that is whatever they invested 1 lakh, and if there is a gain or loss, whatever there in our case there is a gain in fair value of debentures, they will add that amount, that is with 50,000. So it become 1,50,000. On 31st March 2024, the investment is sold before maturity because it's a 10 years investment, and it should be sold after 1 year. And intention of the management is to sold the asset after 1 year in order to invest in better opportunities. So intention is to be checked on the day one, and so it will be recognized through fair value through OCI. And on the at the time of sale, they make an entry. They firstly recognize the change in fair value from 1,50,000 to 2 lakhs. Firstly, they will recognize that asset. They will book the fair value gain investment in debentures with 50,000 to fair value gain OCI to 50,000. After that, at the time of actual sale, whatever they receive, they will debit the bank account and will credit the investment in debenture. And any notional gain and loss in OCI is to be reclassified to profit and loss account because it's an actual sale. The gain arises because the investment is 1 lakh and the sale amount is 2 lakhs. So that sale actual amount received is to be transferred to profit and loss. Any fair value gain, any actual gain is to be transferred from fair value OCI notional gain to actual gain. So from notional, that is OCI is the notional, they will transfer that notional amount to the fair value gain or profit and loss. So profit and loss extract, that is 31st March 2022, gain on the sale of investment in debenture 1 lakh, and balance sheet extract, that is investment whatever they invested plus any gain arises due to investment due to fair value changes, that is to be added, less they had sold, less they had sold that asset, so it becomes nil on the 31st March 2020. Accounting of the investments in debts and equity instruments. Suppose an entity has invested in debt instruments, like investment in debentures shall be classified at fair value through OCI. When business model test to collect and sell an SPPI gets satisfied. The intention of the management is to sell the debt instrument before maturity and SPPI test gets satisfied. Then, if any change in fair value of debt instrument shall be recognized because it's a notional change and it should be recognized in the OCI. How it is notional change, which will explain with the help of example. Suppose A Limited has invested in bond of B Limited of rupees 1 lakhs at an interest rate of 10% for 10 years. The date of investment is 1st January 2023. The fair value on the date of reporting, that is on 31st March 2023, is 1,50,000. So there is a notional change due to fair value. At the time of purchase, they make an entry, investment in bond account debit 1 lakh to bank, and on the reporting date there is a change in the fair value of that asset. They also recognize that because it's a realistic, Ind AS does not says about the conservatism, it talks about the realistic transaction. So if any fair value change in the investment, it should be recognized. So investment in bond is to be increased on the value of the investment in bond is increased from 1 lakh to 1,50,000 on the reporting date. That increment is to be recognized. So investment in bond account debit, that is 50,000 to OCI, and it will impact OCI because any notional this gain is not due to the sale. It's not an actual gain. It's a notional gain. So it is recognized or routed through OCI because firstly it satisfies both the condition of OCI, like the intention of the management is to be seen, business model test is to be seen, and SPPI test is to be fulfilled. So it will be satisfying the condition of OCI, and another one is it's a notional gain and loss. So it will be routed through OCI. So if any interest income is there, it's an actual income, it should be recognized. Now, investment in equity instrument. Investment in equity instruments shall be classified at fair value through OCI when business model test to collect and sell and SPPI test fails. Then investment, if SPPI test fails and business model to collect and sell fails, then by availing the irrevocable exemption, which is provided in case of investment in equity instrument, then it will be recognized through fair value through OCI. So, investment in equity instrument shall be classified at fair value through OCI when business model test to collect and sell and SPPI fails and by availing the irrevocable exemption. Change in fair value of equity instrument shall be recognized in OCI. So any change in fair value of equity instrument shall also be recognized through OCI only. It's a notional gain or loss, so it will be routed through OCI. Accounting treatment will be same as like that of the bond, that if at the time of purchase you will make the investment in shares account debit to bank, and at the time of reporting if there is a change it should be recognized through OCI, and if any income is there like dividend income it should be recognized. Now we will discuss the fair value through profit and loss account, that is FBPTL. FBTPL. Like FB, fair value through profit and loss account is a residual category. What is residual category? When the investment cannot be recognized at amortized cost or fair value through OCI. If SPPI test get failed, such financial assets shall be recognized at fair value through profit and loss account, except in case of irrevocable option for investment in equity. Means residual category is there if amortized cost, if the investment, if the asset cannot be recognized at amortized cost or fair value through OCI, then it should be recognized at fair value through profit and loss account. If SPPI get failed such that the financial asset, then financial assets shall be recognized at profit and loss through profit and loss account, except in case of irrevocable option for investment in equity, because there are two options are there, they will recognize at fair value through OCI or fair value through profit and loss account. Fair value through profit and loss account category shall be applied when financial asset is held for trading. In case of held for trading, it should be recognized at fair value through profit and loss account. In case of derivatives, any asset, financial asset, it's a derivative, then it should be recognized, routed through fair value through profit and loss account. And held for trading means company is operating as a broker or dealer. The business objective of the company is to purchase and sell or financing. So it's a residuary transaction. If any residuary transaction is there, it should be recognized through fair value through profit and loss account. So yeah, we had discussed the classification. I think I able to make you understand the classification in a proper way. So if you like, please help to grow my channel. Please subscribe my channel. In the next video, we will discuss some more important topics on these standards and also some important examples which will help you to understand this standard in a detailed manner. Thanking you for watching my video. Like, please share, subscribe my channel. Thanking you.